All right, welcome to another beautiful day of operations management and the world of inventory control. So for those of you who are really desperate to see more of me, and I can't imagine who that would be, you've noticed I have been starting to record some of these sessions really at the request of the other section, but those are available to you if you want them as well, even though I haven't posted them online. I'm happy to do so. Brief recap again of where we are. Introduction to inventory control this week. There will be a quiz that actually goes live here in about an hour. You have until Sunday to get it done. If you want to sit across your neighbor and talk to your sister on the phone and all that kind of stuff while you do it, that's fine. Just don't do that on an exam. The quiz is totally cool with. Next week, we will be getting a little bit deeper into inventory control. The math and the statistics gets a little bit more complex, so there's actually some sample problems available on Blackboard for you to work through. But this week's quiz will only cover the material from this week. Brief recap. All right, so we've introduced some shareholder value concepts and talked about why inventory cost matters. Things like what drives return on assets, right? It's the operations manager's role to affect return on assets. That, in conjunction with the amount of leverage an organization has, is going to impact a firm's return on equity. And return on equity is a really good financial metric that represents and correlates very well to stock price growth over time. Companies with high returns on equity tend to do very well in the market. Companies with very low returns on equity tend to flail in the market. Right? So one of the key questions then is, well, how do I affect return on assets and thus return on equity? There's lots of different drivers, right? There are sales drivers, there are cost drivers, and asset utilization drivers. You should be familiar with the basic construct of a strategic profit model. If you're given kind of an income statement and a balance sheet, you ought to be able to populate those things. You ought to be able to see, kind of what my asset turnover is, what my financial leverage is. Understand that there are taxes involved, right? The tax man cometh and Washington takes their cut as well. And so in this particular model, right, the taxes is a 50% effective rate. So if you look at the gross margin of $45, the operating expenses of $35, that's a $10 effective operating profit. But if I am paying $5 in taxes, that's a 50% tax rate, right? So understanding those dynamics and how those play out as you then pull various levers for sales, cost efficiency, or asset utilization is definitely fair game for the exam. Regardless, right, because we have both sides of that strategic profit model, we understand that excess inventory tends to lower profits, right, and it also tends to bloat the asset side of the equation, and so that lowers our return on those assets, right? So too much inventory is a bad thing. We also briefly discussed if too much inventory is a bad thing, why do companies hold inventory? What are the key drivers to inventory carrying costs? Those are all kind of strategic concepts reviewed on Tuesday. Be familiar with those. We'll see some of those on the quiz. Okay. Any questions about that content? All right. So today we're going to spend a little bit of time going through 4 key drivers as it relates to inventory management basics. Right. The first is something called inventory turns or inventory turnover. How fast is that inventory that's sitting off on the shelf selling? And am I buying something in January and it's just sitting on that shelf eroding until Christmas time because it didn't sell last Christmas? Or is it tubes of toothpaste and they're flying off the shelf every other day because people are coming in and brushing their teeth, right? How fast am I turning that inventory and how does that impact my business model, right? So that's one of the key concepts we're going to talk about. We're going to understand then a very simple and basic model for determining the right level of inventory to hold, something called the economic order quantity model, right? If you've taken a basic logistics class, you kind of drilled and killed that before. If you haven't taken LSCM 3960, then this is going to be some similar content to that. The other thing that we're going to talk about is how sensitive the economic order quantity model is to errors. The good thing is you can screw it up a lot and not hurt yourself. And so that's why the EOQ model tends to be pretty good and heavily utilized in industries because it doesn't require extreme precision, This is not a clean room electronic manufacturing scenario at Texas Instruments. You can get this roughly right and be okay, right? And the last thing is probably one of the coolest pieces about inventory, and something you can kind of razzle dazzle someone to make them think that you're really smart. And in a fairly complex problem, you can use a really simple rule of thumb called the square root rule to basically size the impact of fairly large, fairly meaningful changes to your supply chain. You can, in a matter of a few seconds, kind of roughly assess the impact of that. So we're going to talk a little bit about those 4 inventory management basics today. All right. So one of the key drivers to the economic order quantity is how much inventory you have, right? And how much inventory you have is going to be a function of how often you order. If you order a lot, then you're probably ordering a smaller amount, consuming that inventory either in your manufacturing line or fewer Dillards. And 20 years ago, you used to walk into a Dillard's and you were completely crushed with 100 dresses on every rack, and you felt like you were claustrophobic in those stores. And in today's world, what you have are 10 dresses on the rack, size 2 to 20 or whatever it might be. And as soon as one sells, you get another dress the next day, right? There's a sense of scarcity. There's a sense of when you go in and look for that dress, I better buy it today rather than wait till the end of the month, because by having 100 dresses on the rack, it incentivizes you simply to wait for the store to put those on sale. But if there's only 5 or 10 of those on the rack, you need to buy it now or it may be gone. Well, what's happening behind the scenes is they're rapidly replenishing that dress as soon as one sells so that the next one comes in the next day so that someone else might buy that. That average inventory is a lot lower if I'm replenishing more rapidly than if I'm buying in huge chunks and it's slowly being consumed over time. So there's some trade-offs to that. Obviously, I've got to have a mechanism to identify when I've got to reorder. And I've got to have people involved in doing that. I'm also probably not going to get as good a discount, right? If I'm ordering in lots of small batches, right, I'm not going to get as good a discount from my vendor. I'm not going to get as good a price on my freight. And so I'm going to have to tend to use different strategies if I'm doing a rapid replenishment model than if I'm ordering in bulk. All right, so different kind of trade-offs there. All right, but one of the key trade-offs as it relates to inventory carrying costs, that was one of the key components that we talked a little bit about on our last lecture, right, is how much that inventory is going to erode, what the cost of capital, what the insurance costs, what the obsolescence costs. That inventory holding or that inventory carrying cost is directly tied to the average amount of inventory, right? And so if I order once in January and I slowly consume that $750,000 worth of inventory over the course of the year, I've turned that inventory once. And if I've got a 40% carrying cost, maybe I've got a 30% hurdle rate on capital employed, maybe I've got to pay insurance and taxes on that, maybe there's some shrinkage, meaning some of you steal my dresses, right? All of that stuff kind of equates to a 40% holding cost. Then 40% times that average inventory of $750,000 is a big number. Conversely, if I'm kind of roughly holding $750,000 worth of inventory, but I've really scaled my ordering and sales and marketing capability where I'm turning that inventory really frequently, right? I'm not buying in January and then slowly consuming it over the course of the year, but I'm buying in January, and on January 5th, I'm turning it again, and on January 12th, I'm turning it again, and on January 19th, I'm turning it again. Then my average level of inventory is actually a lot smaller, right? Because I'm generating those sales and I'm basically dividing it by those turns. And as we can see is as I turn that inventory more frequently, the average amount of inventory held at any particular time is lower. And if I multiply that lower number by a 40% carrying cost, then my holding costs drop dramatically. Right? And we can see, right, there's this kind of asymptotic curve, right? As I go from 1 inventory turn to 2 inventory turns or 3 inventory turns, that's a dramatic improvement in my carrying costs, right? My inventory holding costs drop dramatically as I move from 1 turns to 2 turns to 3 turns. But as I get out on that curve, right, 2 things kind of should be clear. going from 8 turns to 9 turns isn't that big a deal, right? If you're a small company just kind of getting started, it's a big deal for you to kind of put some processes in place, get some controls, get some procedures, and go from 1 turn a year to 4 or 5 or 6, right? There's a dramatic improvement to your business model as far as return on assets, right? But if you're a small business, going from 8 turns to 9 turns isn't necessarily going to be a big deal for you, right? You're going to want to go from 8 turns to 20 turns or 8 turns to 50 turns. If you want to look at Dillard's versus kind of the fast fashion model of Zara, right, where they're flying in runway fashions from Milan every 2 weeks, right? They're turning that inventory very quickly, right? They're looking at 40, 50 turns a year. That's a dramatic improvement, right? And going from 8 turns to 9 isn't going to move the needle, right? You can see kind of how those cost savings flatten out. And you're going to have to, in order to get something more dramatic, you're going to have fairly radical process improvement, right? You're going to have to move from bringing stuff from China on boats to flying stuff on airplanes overnight, right? That's a fairly dramatic change in your business model, right? You're dramatically cutting inventory costs, but you're also absorbing a much higher freight bill, right? Paying for air flights from Milan versus big container loads from China, right? So you've got to figure out where that mix happens in your business. Now, that being said, right, this slide basically says once you kind of get out on that curve, you got to do something big and strategic to make an impact. That's true for your kind of small growing business, right? But for somebody like Walmart that's got $500 billion of sales, right, $400 billion of cost of goods sold a year, right, going from 8 turns to 8.2 turns matters, right? Because you're multiplying a small improvement by a really big number, right? And so while this slide is really focusing on the kind of major process changes that have to happen to make an improvement, the one caveat to this is if you're a massive business, then continuing to go out on that curve, even in incremental amounts, can show some big improvements. And we'll see the magnitude of that in just a minute. Okay, this busy slide is trying to convey a concept of postponement, right? So one of the things that happens with inventory as it goes from way up in the supply chain versus way down the supply chain in the store, right? That inventory becomes much more valuable, right? So think about sand. Sand is a pretty raw commodity. When you scoop it up out of the ground, it's not worth very much, right? But as that sand gets heated and refined and turned into glass, and then that glass gets applied to your inductive touchscreen technology for your iPhone, and the iPhone shows up at the Apple Store, right? The progression of that inventory element has dramatically increased in value for a couple of reasons. One is you tend to change the product. You tend to add value to it as you go through the manufacturing process, right? Increasing raw sand until Corning glass and Gorilla Glass is a huge value add, and so it's worth more as it goes through supplier, manufacturer. But one of the other key things is distribution actually adds value. Moving sand from northern Wisconsin, right, and bringing that to a frack job at an oil well in southeast Texas, just moving it closer to the oil well is adding value. That distribution cost, the packaging, anything that may be associated with moving it up the supply chain adds value to that inventory, right? So if inventory is getting more valuable and thus more expensive as it moves up the supply chain, that's what this chart on the left is showing, right? Then the carrying costs, right, the holding costs of that inventory is going to go up as it goes through the supply chain, right? Because I'm applying that 40% hurdle rate to something that's more expensive. And so if you're an operations manager and you want to lower those holding costs over time, then what you want to do is employ a postponement strategy, right? You want to delay the value add activity up until the last possible moment, right? Simple illustration of that is Home Depot. You don't go into Home Depot and see 57,000 cans of paint, right? You see a little cardboard swatch board with 50,000 colors of paint and maybe 50 buckets of white stuff, And when you're ready to go paint your kid's bedroom in the, rubber ducky yellow color or whatever, right? They squirt the little colors in it and turn it into your Ralph Lauren rubber ducky yellow. That is a postponement strategy, right? If Home Depot had to hold all 57,000 cans and colors of paint, that'd be massively expensive for them, right? Versus if they're postponing that value add activity to the last possible moment, they can defer that carrying cost and respond to your needs as they happen, right? So the right-hand side of this is showing you that basically as I not only move across the supply chain, my carrying costs are more expensive, but again, if I can use postponement to delay that cost, and if I can be in a rapid replenishment model where I'm responding and turning that inventory very quickly, then again, those holding costs go down over time. Okay. All right. So we've talked about turns, going from 1 turn to 2 turns to 5 turns. Now we're going to pretend we're all finance majors for 5 minutes. Okay. So how do you calculate inventory turns? Right? Well, you got to know 2 key data points. The first is you have to know the cost of goods sold for some period of time. Right? Cost of goods sold is on the income statement of there's 3 financial statements that every company publishes: an income statement, a cash flow statement, and a balance sheet. Income statements and cash flow statements represent periods of time. Balance sheets are snapshots at a particular point in time, right? So if I wanted to know what was my cost of goods sold last year, I would just pull up the income statement from last year, and it would say everything, all my revenues from January 1st to December 31st. It would say all the cost of goods sold that I had to basically buy from my suppliers to turn into revenues. It would show that for that period of time, right? So my income statement tells me my cost of goods sold. But if I want to know my average inventory level, right, that's the second part of this equation for inventory turns, I have to go to my balance sheet, right? On my balance sheet shows me things like the cash that's in the bank, my accounts receivable, my inventory. All of those are considered short-term or current assets. It also shows me long-term assets like plant, property, and equipment and those types of things. It also shows me my liabilities like loans that I've taken from the bank or accounts payable that I owe to my suppliers. All of those kind of represent my balance sheet. But the problem is the balance sheet, if I wanted to know my inventory turns for 2016, my 2016 balance sheet shows me my inventory on 12/31/2016. It's a snapshot in time. It's a snapshot at the end of the year. What was on my balance sheet? How much cash did I have in the bank on 12/31/2016? How much inventory did I have on the shelf? Right? Who did I owe money to? It's a snapshot in time. And so if I want to know my average inventory, I have to get 2 balance sheets. I have to get the balance sheet from 12/31/16, and I have to get the balance sheet from 12/31/15, and get the average of the 2 inventory levels. Right? So here is an extract from Walmart's 2016 annual report, and we see revenues, cost of goods sold, operating expenses, taxes paid. Right? We can see that this company spent they sold a little under $500 billion in 2016. And a slight nuance here, this is their fiscal 16, which ended like in February of 16. So it's almost a year behind the calendar, right? But it's fine for our purposes here. So in fiscal 16, they sold about $480 billion, and $361 billion were considered their cost of goods sold. I have to go to my balance sheet and look at the 2016 and 2015 balance sheet to understand what the 2 inventory levels were. And once I have those 3 data points, I can calculate what my inventory turnover for Walmart was in fiscal 2016. It was a little over 8 turns for the year. Right? They're turning that inventory over 8 times. Right? Seems a little low. Right? I would think that they're probably flying through some Crest toothpaste a little bit more fast than 8 times a year. But this is their average inventory of everything they own, right? So they own basketball hoops and, desks and Crest toothpaste and lawnmowers, right? And so they probably sell a lot of lawnmowers in April. They may not sell a lot of those after April, right? And so when you look at all of that inventory over time, they're basically turning it 8 times a year. As an ops manager, you probably want to understand how you're doing, right? This is a kind of 15-year view of Walmart, right? Several years ago, they were sub eight turns a year. And then kind of during the financial crisis, they were basically purging inventory, right? They're saying, hey, we're not necessarily going to buy a lot of new stuff. We're just going to try to get rid of the stuff we can, right? And so they were really turning inventory in '09 because they were basically selling a lot without replacing it with new stuff. And so that's why you saw this huge ramp of inventory turns in the '08, '09 timeframe, because they were trying to manage how bad this downturn was going to be. People started coming out of the downturn in 11 or 10, 11, 12, right? So they started replenishing a lot of that inventory, but the economy was still a little bit sluggish. They kind of bottomed back out close to 8, right? They were 8.06 in 16, right? This is a simple report I pulled from the Bloomberg lab right upstairs that all of you have access to. You can, as a student, get out on the Bloomberg and say, hey, what's the inventory turnover for, right? So interestingly, that the number actually relates directly to, so these kind of tick and tie. Fiscal 17, which ended 2 months ago, right, shows that they got a little bit better with their inventory turnover last year, right? And so, interesting just to kind of see how Walmart's doing over time. Yeah.
How would a service company measure inventory, like an airline, for instance? What would they, first of all, would that metric matter to them?
They're probably going to be looking at revenue per available air mile and those types of things. And so they're going to be looking at their inventory not as their airplanes, right? Because they're not buying airplanes and selling airplanes. They're really typically, and most of them don't even own airplanes anymore. They just lease those from operating companies. But their inventory is their seats that they have. And, they're going to be looking at, well, how many seats am I available to sell? And so inventory turnover is probably not as a big a metric for them as inventory utilization, right? I had all these seats. So one thing for Walmart, right, is once they have the Crest tube of toothpaste, it's not like if it doesn't sell tomorrow, it's gone. It doesn't just vaporize. But an airline, if they've got the seat that's going from Dallas to Chicago and no one's in it, that inventory just vaporized, right? So that's kind of cost of goods sold that they had that they didn't get any sales from, and it's gone, right? And so inventory turns isn't as relevant as a metric as inventory utilization. All these seats that they had that are basically going to expire on Tuesday, right, on that flight, did they put your butt in that seat or not, right? That's a really important metric for airlines. Okay. So we talked about if you're a small, medium business, you don't want to go from 7 turns to 8 turns or 7 turns to 8.2 turns. You want to go from 7 turns to 20 turns or 20 turns to 50 turns, right, to really make meaningful improvements in your business. If you're selling $500 billion worth of stuff, then even modest improvements in inventory turns matters, right? Let's look at the 8.06 turns that we saw in 2016, right? Let's say we got some logistics, supply chain, operations management folks together and said, how can we get back to that 9-turn level that we saw during the Great Recession without going through the Great Recession, right? Is there something that we could do to do even just moderately better at Walmart, right? And, if I'm at a small manufacturing facility in Dallas, I'm not talking to them about trying to go from 8 to 9. But for Walmart, going from 8 to 9 is a big deal because if I have the same cost of goods sold of $361 billion and I go from 8 turns to 9.1 turns, right, roughly 1 turn higher, well, solving for X, in order to get 9.1, that means that my average inventory is $40 billion, right? And so for Walmart, going from 8 turns to 9 turns basically frees up $5 billion worth of inventory in the system. That's a meaningful chunk of change, right? That's a significant amount of cash to go buy, Jet.com, right, that they just bought a year ago, right, to compete with Amazon. That's a significant amount of cash to go build a whole fleet of distribution centers in China, right, or whatever it is you want to go do, right? So if your job as an ops manager is to try to figure out how do I free up capital to increase return on assets, heck, just taking that money and giving it to the shareholders as a dividend could be nice. I like a little $5 billion in my hip pocket. But if I'm also looking at, hey, I could take that money and instead of it sitting in inventory, I can build new distribution centers, I can build new online capabilities to compete with Amazon, that is going to sustain its competitive advantage over time. So even small changes for really big companies can matter, right? Just a rough benchmark analysis, right? Amazon, right, tended to kind of have fairly high inventory turnover, but then as it kind of started selling everything in the world and not just books, right, its turnover became much closer to Walmart. Interesting. You compare Walmart's price and Amazon's price over the last few years, done pretty well. Look at Target, right, significantly lagging its two peers, right? So I would think that that might be something, and especially over the last year or so, right? Dramatic erosion in their inventory turn capabilities, right? And so something interesting, maybe bad, is happening at Target. We'll definitely want to explore that. Okay. So that's kind of strategic topic number one, inventory turnover, right? How that affects postponement, how that affects inventory holding costs over time, right? Better turns or faster, or better turns or better. Faster turns are better, if I can get that out. All right, so now we want to spend a little bit of time talking about topic number two, which is the economic order quantity principle. Right? So this really got its kind of legs underneath it several years ago, 50, 60 years ago, when ordering stuff was some lady with a pencil in her hair, getting out, filling out a form and mailing it to somebody, right? And so it was a question of, well, how much should I pay Alice? How many Alices do I need, to be my order entry people versus how much inventory should I have? And there was this trade-off between the holding costs of inventory and the ordering placement costs, right? How many Alices do I have to have in my procurement department? In today's online XML, EDI ordering world, this is probably less important, right? We can really streamline our order placement costs. And we tend to look at other things beyond placement costs, things like purchase discounts and other things as kind of key drivers to this. But the economic order quantity model kind of got its basis on this seesaw of, well, I can either have fewer Alices, but I'm going to have a lot more of an inventory carrying cost, or I can have more Alices and I'm going to have lower inventory carrying costs, and I got to manage that trade-off. Okay? So this is what it's based on. So we use the model to say the best economic order quantity for you to have is whenever you place an order, buy 350 units. And how did we know that? Well, we had to have some key inputs to the model. We had to know the demand that we were likely to incur over time. So you're going to have a really good marketing function that understands what that demand profile is going to look like. We also have to have a really good procurement department that knows how fast we're going to get our return materials, our inventory that we order from our suppliers. In this particular instance, a key input to the model is that we have a 2-day lead time. So that when I do place my replenishment order, it's going to take me 2 days for my supplier to send me that replenishment order, right? The demand and the lead time is key. And then obviously part of that demand is usage, right? How much do I consume each day over time, right? With those three inputs, I can define how much my order quantity should be, right? If I'm going to use 50 units a day and it takes me 2 days to get it and my total order quantity is what it is, I can kind of plan this where I get a big surge of inventory coming in, I start consuming it. When it hits my kind of reorder point, and we'll talk a little bit about that next week, when I hit that 100 unit level, hey, I need to place a new order when my inventory on the shelf hits 100 because I'm going to consume 50 units a day and my lead time is 2 days. And so 2 times 50 is 100, so when my inventory on the shelf is 100, I better place a new order, right? And this sawtooth diagram assumes everything works perfectly, right? That my demand is exactly the way I forecasted it to be, that my lead time is exactly 2 days, and that nothing bad ever happens ever, which is really wonderful, right? But that never happens. And so what we're going to talk about next week is how this theoretical perfect world changes when we have uncertain demand and uncertain lead times, right? What happens if my demand is bigger than I thought it was going to be? Or what happens if my lead time is slower than I thought it was going to be? That really messes with our model, and we got to kind of build some parameters around that. Okay? But knowing that that's the theoretical model, we can build some theoretical frameworks around that. We can determine what our average inventory level is going to be, right? It's just the average height of that triangle, All right, if you remember back to geometry, the average height of a triangle is 1/2 base times height. Right, so I understand I got 350 units. I divide that by 2. Right, that's going to be the average level of that inventory over time. If that's my average level of my inventory, then if I multiply that average level by the carrying cost, right, that's the C, and I multiply that by the value of the inventory, that's the V, the combination of those things is my holding cost. Right? The book consolidates the C and V variable into something called H. Right? It just assumes you're always given holding cost. But in the real world, you're not just given holding cost. You tend to have to define your carrying cost. You tend to have to go look at the cost of goods sold to see what the value of the inventory is. And so while H is what the book uses in its formulas, I tend to break it out into its 2 subcomponents because that's what happens in the real world. The other thing we have to understand in the seesaw diagram, so that's the holding cost part of the equation. The other part of the equation is the order placement cost. So the first question is, well, how many orders am I going to place a year? Well, that's going to be a function of what's my demand for the year and what's my average level of inventory. If I divide those two, that's going to tell me how often I'm placing those orders. And then if I multiply that by P, my order placement cost, whatever I'm paying Alice to sit in the office and place, or it could be little Billy, right? I don't want to be sexist here. Whatever I'm paying whoever is in the office to place the order, that is my holding cost. The book calls P S. I don't know why. P makes more sense since it's placement. I don't know what S could possibly stand for, but these will be the variable letters that I will use in my notes because I think they're a bit more intuitive, right? But if you're trying to relate my notes to the book, C times V is H, and P is S. So that's how you translate between the two. Okay. All right. So once I know all those variables, I can tell you what the total cost of balancing my order and my holding cost and my placement cost. So I just add those two things together. And if I do a little bit of algebra, I can solve for X and determine what the cost optimum economic order quantity is. Right? It's just the square root of those variables. Okay? So how about an example? I tell you that there's a demand of 2,000 units a year. The average value of the inventory that's sitting on the shelf is $50 a unit. It costs me $500 an order for whatever reason. And we have a fairly low cost of carrying costs. We're not paying a lot of taxes, not paying a lot of insurance on this big pile of sand that we have outside. And so our carrying costs are only 25% a year. Right? Plug those 4 variables into our equations. I can say, well, you ought to order 400 units whenever you do place an order, and the total cost for this is going to be $5,000 a year. Right? The total cost of managing the holding cost of your inventory and the placement cost of your inventory is $5,000 a year. Okay? So that's concept number 2, the basic economic order quantity formula. Right? I should be able to give you 3 of those 4, and you figure out everything else. Right? Shouldn't be that hard. All right, here's concept number 3. The cool thing about the economic order quantity is if you screw it up, it's not that big a deal. Right? Unless you really screw it up. Okay? And so little mistakes, no problem. Big mistakes, you're an idiot, and you're gonna pay for it. Right? So if green is the scenario, right, you ought to be ordering 400 units a year. That's what we just modeled, right, based on a demand of 2,000 units a year. If in reality we ordered a lot less, right, or a lot more, that's problematic. I mean, you can see that the increase of costs, right? The increase in cost is like 2.5x if I order a lot more, like 5 times more, right? But if I order, 10 times less, that's a lot worse, right? I mean, so making big errors is a problem. But if I'm off by 20%, even if I'm off by 50%, look at the 400 versus 200 there. My total costs don't go up that much. Okay? And we can see this really on the next page, right? This is kind of doing an error sensitivity. And you can actually define your error by the ratio of your estimated demand and your actual demand. And you can kind of see what the impact is, right? But what we're basically showing in this slide is if the actual demand was 2,000 units and you thought you were going to sell 3,000, and so you bought so much extra inventory to kind of meet the demand of 3,000 units being sold, but only 2,000 units were sold, and your manager comes in and goes, "Why were you such an idiot? Why did you use such a huge forecast for expected demand? I bet our inventory costs are through the roof." And you say, "Shut up. Our total holding costs only went up by 2%, right? Your stupid forecast was off by 50%. My inventory costs were only off by 2%. Go talk to the sales and marketing department because they're the idiots, right? So as an inventory manager, because of this, what typically happens is it's very common in organizations to hold more inventory, right? Because if you're holding more inventory, if you're planning on 3,000 units being sold, and you're wrong, only 2,000 get sold, it doesn't hurt you that much. But if you're planning for 2,000 units and you had a demand for 3,000 and you couldn't sell that stuff and they went to your competitor instead, oh, everyone's mad. Right? Everyone's coming unglued because we lost all these sales. Right? We didn't have enough at Christmas time when everyone wanted the Tickle Me Elmo. Right? Huge problem. Right? And so what tends to happen is because ordering a little too much isn't that big a deal, is people tend to order too much. And so as an inventory manager, you have to balance the reality of, should I order a little more knowing my inventory turns are going to be bloated? Right? I'm not going to get 9 inventory turns this year. I'm going to get 8 inventory turns. And if you're Walmart, right, $5 billion matters. And so you got to kind of manage all of that bucket of expectations. Right? The risk of a lost sale versus maybe $5 billion I could go invest in something else. Okay, that was strategic concept number 3. Right? The error rates are not that big. The total costs are not that big a deal if your errors are reasonable. Okay? Strategic concept number 4. You're sitting around a conference room table in your Home Depot. You're saying, hey, we're going to expand into the West Coast, right? We're an East Coast business. We're going to open up into all of these new markets. We're going to need to go from 9 distribution centers to 25 distribution centers. Holy crap. Right? So if I'm going from 9 to, let me do the math, maybe it's a little easier. Maybe I'm going from, we'll go 9 to 25. So that's 16 new distribution centers. So do my inventory costs go up 16 times? Right? That might be one, if you're trying to sit around the table going, my gosh, how much more capital am I going to have to fund this business? And I go look and I'm spending $100 million on inventory for my 9 distribution centers, and I'm going to scale to 25, right? So that's 16 more. Does my inventory cost go up by 16? No. It goes up by the square root of the number of locations. Okay? So the scaling factor isn't simply, it's not linear. It's the square root of the beginning locations and the ending locations, right? And this ratio applies to units of inventory. So if you're saying, I've got 5 vials of snakebite venom, and I've got to open up all these new hospitals, do I need a new vial for every hospital? No. You scale by the square root of the locations, the ratio of those locations, right? So whether it's units of inventory, dollars of inventory, total costs, whatever kind of whatever units you're measuring it in, it's in this ratio dynamic. Okay, so let's give an example. All right? Let's say we had one central distribution center where all of our inventory was consolidated. Right? We had a demand of 2,000 units. Our order placement costs were $500. We had inventory carrying costs of 25%. The average value of the inventory was $50. This is the exact same problem we saw about 4 pages ago, right? So the economic order quantity was 400 units, and the total cost of the system was $5,000. And now we say, hey, one central distribution center in Dallas isn't really cutting it. We need 4 distribution centers to really expand our coverage nationwide. So we're going to have a Dallas DC, an Atlanta DC, Provo, Utah DC, and maybe something in New Jersey, right? And that kind of gets us our rough coverage for the nation, right? So do our costs scale by 4? No, right? going to 4 locations, what happens is our demand is divided across those 4, right? So instead of 2,000 units per location, we get 500 units now per location, right? 2,000 divided by 4. The order placement costs are the same. The inventory carrying costs are the same. The value of the inventory is the same. But when I plug those 4 variables into my equation, my new economic order quantity is 200 per location rather than 400. And my total cost is $2,500 per location instead of $5,000 for the one. And so if I'm at $2,400 for each location and I got 4 locations, that is $10,000. So I started with a $5,000 total cost at one location. We're sitting around the conference room table saying, we really need 4 facilities. And your manager says, oh my gosh, our inventory costs are going to go up by 4. We're going to have $20,000 of total cost. You say, no, you idiot. It's only going to go up by a half. Because as we look at scaling inventory, it's the square root of the ratio of the number of locations, right? So square root of 4 is 2, square root of 1 is 1, right? And so it doesn't go up by 4, it goes up by 2. If I was scaling from 9 locations to 25, it would scale by the ratio of the square root of 25 over 9, right? So it would be 5 over 3 or 1.8, right? So it's not going to scale by 16. It's not going to even scale by 2.5. It's going to scale by the square root of 25 over 9, which is 5 over 3, whatever that turns out to be. 1.67, I guess. Does that make sense? This is the magic formula, the square root rule, the rule of thumb that can be the whiz-bang formula that you whip out at the conference room table, because it doesn't matter how many locations, what you're talking about, it's a simple rule of thumb that gets you there. That's it for today. So, understanding the stuff from Tuesday, understanding the stuff from today, that will all be covered on the quiz that goes live in about 15 minutes. Have a wonderful holiday weekend.